Hey folks, want to talk about something slightly controversial in terms of trading. So in reality, it's not that controversial. So I've been trading currencies since I was 18. So I've been around the block and I've done all sorts of things. I've lost a fortune, I've made a small fortune. And one of the things I see all the time is people strategy hopping. So they'll have a little losing streak and they'll massively change what they do. Or they don't identify that the strategy that they are deploying is only suitable for a certain market condition. Like for example, if you're a trend trader using, I don't know, moving averages or some sort of oscillator, typically your strategy will probably be really good for steady and volatile trending markets, but the moment it starts ranging, you'll then get whipsawed, which happens to me a lot actually, because I am a trend trader. Now, over the years, and if you read any sort of trading book, they will always say that you have to always use the same max risk per trade regardless, yada yada yada. You should never have a trade that you remember, whether it's a good or bad trade, because every trade should be the same risk profile, yada yada yada. And I used to trade like that for a good decade, and unfortunately the way that the markets have evolved, trading that way just doesn't work anymore. If you look at any of the big traders that have actually made a lot of money in this space, they don't trade like that, and you'll see that they vary their position size depending on the circumstance, the setup, conviction and probability. So yes, your bread and butter trades should be 0.1 to 0.25% of your whole account, and then on top of that, you should also have total exposure of assets. So your trading risk profile should be like a bowling alley, and within that bowling alley you should have certain things like no more than say 2.25% max risk per trade, no more than 5 or 10 trades open at any point in time, no more than X% exposure to a particular asset class, etc, etc, etc. But what I have found personally is that there are sometimes, probably once a year, once every 18 months or so, that a situation will pop up where there is an extremely high probability of something playing out, and everything matches your trading criteria. And so in those occasions, you should actually gear up a bit. You should put the jacks under those trades and lever up, or risk a bit more. So this then takes us into the remit of normal trading and position trading, or high conviction trades. And so every single time I've made money in the markets has been due to these low risk, high probability outcome setups, and also gearing up in those trades. Sorry, the sun is making this all blurry. Now, sometimes, like for example myself, I have seen probably a couple of low risk, high probability outcome trades this year, and I've got them wrong. So this is the downside to that. So sometimes if when it goes right, great, but when it doesn't, you can get stung. And I've been hurt twice this year from these supposedly high probability trades not playing out. So what you have to also tally into this is that when shit hits the fan, you don't risk too much of your pot where you're out of the game. So I mean, I never go and risk 100% of the whole account on a trade, etc., whereas a lot of gamblers do. So even if you do get a hit, yeah, it's gonna sting, but you're not out of the game. You're still there, and you can fight. So and also not changing up your strategy every 2 freaking minutes. And so I think that's the key. Everyone's always strategy hopping and looking for that holy grail. It just doesn't work. It really doesn't. And also, by understanding, I guess, the wider context of your trading style, method, and the scenario, or the environment that you're trading, it allows you to be calculatedly courageous, if that makes sense. So what I mean by that is, the best times to short a market are when the markets are booming, and the best times to buy a market when they are diving. So for instance, right now it is the 4th of November, and You know, macroeconomics, the fundamentals are just atrocious, but Bitcoin, Ether, they're all booming, right? Putting on a short in the middle of a steam train up like that seems horrendously scary, right? You know, because when things are moving up so fast, you think, oh my God, it's all-time highs this time next week. But it's actually in these situations where you actually need to start scaling in your shorts. You don't just go all in one trade. You put some little tasters out there. And also, yeah, so that's the way to do it. And it's hard to be, let's say, calculatedly courageous like that. Whereas what happens is people, they do the opposite. Stuff starts dumping and they start shorting. Stuff, you know, starts booming and they start buying. And also, this is actually a very important thing. One of the holy tenets of trading, Pips, come here. Sorry, my dog's gone too far away. One of the tenets of trading is all about risk to reward ratio. So your triple R or your R multiple. Now, I talk about this a lot because it is very important, especially for someone in my situation where I'm also teaching brand new people to trading. So I have to teach religiously R multiples, etc. But when you look at the pros, when you look at the big boys in the trading game, as in billionaires like John Paulson and all that, and Paul Tudor Jones and all that, John Paulson and Paul Tudor Jones, you'll see that these pros, or I wouldn't say pros, these trading celebrities, or these, you know, proper Gordon Gekko, so to speak, they don't trade like that. They don't trade like retail does. They yes, they care about risk reward ratio, etc., but they don't execute into the market like that. What they're doing is they take a big, wider macro picture and go, right, everything's saying this should start falling, and then they'll start scaling in a position. So yes, initially when they're putting in the first few ladder trades, etc., the risk to reward ratio may seem horrendous, because what they're doing is they don't effectively have a stop loss. They have a mental sort of exit position where they all have to start reversing out of the trade, but they are constantly scaling in. So your risk to reward looks absolutely pants, but when fundamentals eventually come true, and it may take a month, it may take a quarter or half a year to start playing out, then they've got their positions in and they're ready to roll. Now, one of the hiccups, one of the things I have screwed up on this year is I've taken that style of trading, which does work, and it's worked for me beautifully in the past, but I've done it with derivatives trading on crypto, and it's fine, but the thing is you get absolutely rinsed in terms of your holding fees. So depending on what platform you're using, GMX, they call it a borrowing fee. Bybit, I think they call it a I think it's just called a borrow fee or borrow rate or funding rate. You will just bleed to death. So for example, not long ago I had a position on the market where, because the trade was quite chunky and I had scaled in over a period of time, I was paying a good $9,000 per day just to keep the trade open. So what happens with that is, you know, if you're bleeding, say, whether it's $9 a day or $9,000 a day, it doesn't matter. It's all relative to the size of the position. What that does is it eats into your collateral, it reduces your liquidation level, etc., etc. So I think being completely safe, you should probably only do this when you're laddering in your buys. So when you come to spot buying and you think you've hit the cycle low, start laddering your spot buys like that, and that way there's no liquidation risk. Anyway, a bit of a ramble. Hope it helps. And the thing is, with trading, there's so many nuances. But yeah, right. Bye.